Hey guys, it's Rose here with Finance and Crypto. I want you guys to keep in mind that this video is from December 28th of 2017. So let's go ahead and take a look, and I'll provide a little bit of commentary throughout.
I would say, David, that this year is the culmination of GE having brushed things under the rug for decades. And all of a sudden, this has finally come home. The CEO and CFO have both departed, and the earnings, cash flow, and dividend have all collapsed. And it's really hard to see how there aren't massive lawsuits that are going to ensue.
Massive lawsuits?
Oh, absolutely. These have already started class action litigation.
Let me go back to your point. You were talking decades, is what I think you said, or many years of pushing things under the rug. So even back to the time of Jack Welch?
Jack Welch handed Jeff Immelt a tough hand. And unfortunately, the company really never did a reset. They continued to propagate the upside driven by GE Capital. GE Capital lies at the heart of a lot of the company's problems, and today it's sitting on billions of liabilities, including long-term care insurance and other things.
Although the long-term care is an interesting point, and one that we've discussed a bit with Flannery in his brief time.
Right.
But GE Capital's gone. I mean, of course, they did sell it, as is so often was the case, at the low, it would seem, in terms of a multiple to book value.
But they retained the liabilities, and it's been the factory for GE's very low tax rates. The tax rates were minus 4% in the third quarter. Almost every other company in America wins through corporate tax reform. GE's a big loser. They're going to face a big forced repatriation, and there's other provisions in the tax changes that are likely to cause the taxes to rise.
So you don't see 2018 in terms of as a rebound year for this company under Flannery?
Not at all. It's going to take a very long time to turn the ship around. Meanwhile, the company's going to be challenged to grow. It's firing thousands of workers. How's it possibly going to be able to to grow under those auspices? It's going to suffer distraction costs, and meanwhile, it's being forced because of its cash squeeze to sell prized assets like rail. The lighting business, which it's tried to sell in the past. Baker Hughes, we think, is on the block this year. All these things.
This year in 18, you think it'll be on the block? What is the ownership? 60-something%, right?
Yeah, it's 62.5%. Right. We think that 2018 could, in fact, be the year they dump Baker Hughes. And theoretically, Rail and Baker Hughes are at the bottom of their cycles. Now would not be the optimal time to be selling these properties. But as you said, their timing historically is pretty poor. They buy high and sell low.
We criticize.
Now, he had a lot to say there. What I wanted to point out, Baker Hughes, which is one of GE's assets, currently is trading at around $21. Now, he was saying this about GE in 2017, December of 2017, all the problems that they were having, where GE was currently trading at that time around $17. Today, everything he stated previously has come into fruition. Not just that, GE is trading at $7.10 at today's current levels. And it's actually traded lower. I mean, it just got a recent boost a couple of days ago. But my question is, listen to what this Deutsche Bank analyst is saying about GE in 2017 and think about where GE is today, knowing that interest rates are going to go up next week on December 18th or 19th after the Fed performs their meetings. And then again in March. Could GE potentially be the next Lehman or Bear Stearns, given the fact that their leverage levels are 2-to-1 over their assets? This is a legitimate question to ask right now.
Them out for many years in terms of his both buying and selling at lows and highs. But one thing that a lot of people seem to miss was the inability to execute at some of the key businesses, power being the chief one. I mean, did you have a sense as to how badly things were going there prior to us learning about it?
It's turned out to be probably as bad as many who were fairly bearish had perceived or had feared, if you want to put it that way. It's going to be surprising to a lot of people from the outside. But look, GE is a big, complicated company. For years, they sort of masked their results. They propagated the fact that everything was great all the time. It was very difficult for analysts or outsiders to actually pry into the company to see what, in fact, was happening. But no, I'm not really that surprised. I know a lot of people are surprised, but I'm not really that surprised.
And finally, let's just get back to this.
So just listen to what he said there. GE masking, their corporate woes, essentially making it seem that everything, was up and up and, going fine and well. Let's just not forget that GE along with other corporate companies since 2008. The corporate debt has increased over 50%, with interest rates needing or getting ready to be risen again on the 19th of December and again on March, I believe, somewhere between March 8th or 9th, for an additional rate hike. Where is this going to lead? I mean, we have the Federal Reserve pulling back on their balance sheets, which is affecting the stock market. We have corporate debt increasing to a level that we have never seen before, while interest rates are being risen on these corporations that are going to be needing to service these debts.
Stock itself sitting here at around 17 and a half bucks or so, $17.31 into next year. I mean, cash flow generation, anyway, with any metric that we might use to try to value it. What are your expectations for next year when it comes to that?
The cash flow. So firstly, I think the earnings are coming in around $1. 2019 is frankly not going to be much of a better year. The earnings are going to come in after they sell rail and Baker Hughes and other things somewhere around $1. The stock looks like it's worth $15 at best. In fact, GE Capital, given all the liabilities and money it owes, theoretically could have net negative value. So the dust hasn't settled on this thing yet. Frankly, they might even have to cut the dividend again. That's not entirely clear. So the cash is going to be volatile. The earnings are what to watch. But, GE still suffers from aggressive accounting. It never really addressed that as part of the transition or the meeting on November 13th. And so, all that is still out there and is probably going to have to be dealt with over time. Not to mention all of the restructuring. This company is juggling a lot of balls. Let's put it that way.
So, guys, I just want to end it there. And please comment below. Let me know what you think.